Welcome to Spiedel's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering proposed changes that the pending tax bill would make to the state and local tax deduction limit. Stay up to date with federal tax law changes with Spiedel's Federal Tax Letter, a monthly newsletter plus a searchable online archive of back issues that keeps you at the leading edge of the federal tax issues that will impact your clients. You can get details and subscribe at spiedel.com under Publications. While many taxpayers have been relieved to hear that the One Big Beautiful Bill Act would increase the SALT deduction limit from $10,000 to a maximum of $40,000 or $20,000 for married filing separate taxpayers, many taxpayers will be surprised by some of the fine print related to the SALT cap changes contained in the bill. It's this fine print that's causing many professional trade associations, such as the AICPA and CalCPA, to urge their members to contact their federal legislators because their members and their members' clients may see significant tax increases as a result of these changes. If enacted, the OBBBA would allow an increased SALT deduction limitation for individuals for specified taxes. Specified taxes generally include state and local property taxes, both real and personal, and state and local income and sales taxes, as long as they're not an accepted tax, which we'll discuss later. The OBBBA will also expand which taxes are subject to the cap. Under the OBBBA, the specified taxes subject to the cap would also include a substitute payment, which is defined as any amount other than a specified tax that is paid, incurred, or accrued to a state or local government if the payment would entitle a person to certain tax benefits like credits, refunds, and deductions equal to or exceeding 25% of the amount paid. This would apply to the SALT limitation workarounds that various states have enacted since the TCJA SALT limitation was enacted. The OBBBA would require partnerships and S corporations to separately state various taxes on the K-1, including substitute payments, and would prohibit the partnership and S corporation from claiming a deduction for these separately stated taxes and payments. These changes effectively repeal IRS Notice 2020-75, the IRS guidance that allowed partnerships and S corporations to claim a federal tax deduction for pass-through entity elective taxes. Repealing the ability of pass-through entities to claim this federal deduction for the pass-through entity tax would essentially eliminate most, if not all, of the benefits of making such an election, and may result in many states repealing their pass-through entity elective taxes. However, the OBBBA would provide a silver lining for some pass-through entity owners. The bill would also create a new category of accepted taxes, which would be fully deductible and not subject to the $40,000 or $20,000 caps. Accepted taxes include foreign income taxes, state, local, and foreign real property taxes that are paid or accrued in carrying on a trade or business or an investment business, and state, local, and foreign income, war profits, and excess profits taxes paid by a qualifying entity in carrying out a qualified trade or business, which does not include specified service trade or businesses. The first two are already exempted from the current $10,000 SALT limitation under the TCJA, but the last item is a new exception to the limitation. A qualified entity is any partnership or S corporation that derives 75% or more of its gross receipts from a qualified trade or business under IRC Section 199A, but does not include specified service trade or businesses such as accounting, healthcare, law, and investment management. This means that a partner and members' separately stated taxes from the partnership or S corporation would be subject to the $40,000 or $20,000 SALT cap, but only if the partnership or S corporation is a specified service trade or business. Partners or members of qualified trade or businesses that are not specified service trades or businesses would be able to fully deduct their share of the state, local, and foreign taxes paid by the partnership or S corporation, even if above the $40,000 and $20,000 limitations. Sign up for Spidel's 2025 Summer Tax Webinar, which is packed with expert insights on the top issues raised by you and your fellow tax professionals. Topics include maximizing profitability in your practice, reporting real property transactions, non-resident issues, and retirement planning. Get details and register at spidel.com under webinars. That's all for this week. Join us next time for another episode of Spidel's Federal Tax Minute.